Russia has gone into these anticipated sanctions with, at best estimate, a $650 billion war chest. Now,
Russia and Ukraine has escalated, driving the gold and silver prices higher. Can you just run through these fast-changing dynamics and what it means?
yeah, great to be with you again, Shane. Yeah, absolutely. This is pretty wild stuff going on here. Even the analysts at Bloomberg and places like that, literally the mainstream media is confused as to what's going on, especially in the commodity market. So let's start, and obviously we'll look at gold, we'll look at silver. Let's start with the short term, and then look at what it really means for the price of gold and silver over the medium and long term. Look, we're going to continue, much like today here, we're going to continue to expect really heightened volatility driven by intraday ebbs and flows of Russia, Ukraine escalations, de-escalations. I mean, the narratives just cannot always be trusted, but notable information coming to light through this volatility is first-hand feedback from our very well-connected liquidity providers. As you know, we're very close to the wholesale market. And these liquidity providers have strong ties to all the global markets. And that includes the Russian central bank, which has been buying every single ounce of available physical gold, cleaning out immediate as well as forward purchasing all local Russian supply deep into all of 2022. So not only does this keep Russian producers busy, but it telegraphs that Russia's intentions for employing physical gold, especially in a time of sanctions. Now, these reports that the Russian central bank would recommence gold purchases on Monday the 28th was published by Reuters, but they didn't go into the scale of these gold purchases. And while this information has 100% been verified by our own liquidity providers, it is no surprise. If you remember, back in a previous episode, back in January, I think it was, certainly was a couple of months ago, that the Russian central bank had not just banned all gold exports, which was the case before, but they were also banning all scrap gold exports. We made a huge deal of that because we said they were really, essentially, they were telegraphing something there. And really what we're finding out is they were readying their war chest in anticipation of sanctions, which we couldn't have known at the time. But certainly it was very, very strange that when they was withdrawing even scrap gold exports. Now, it's clear now that the Russian central bank gold accumulation policy, which has openly been underway for quite some time, was being stealthily accelerated. Now, obviously, this beggars the question why. I mean, that's what we get all the time. So, but much like China, Russia's physical gold reserves are assessed to actually be multiples more than what is officially disclosed. Now, both Russia and China will choose their moment to disclose these aggregated holdings. Now, they will announce these holdings when they employ the nuclear option of replacing the petrodollar, which is settling vast Russian oil reserves for physical gold. Now, sanctions have put what was probably a 5 and a 10-year plan right on the front burner. And this is what I think is our main focus here. This is definitely a huge deal. Now, look, obviously, while our hearts go out to everyone unfortunate to be caught up in the misery of a hot war, I do honestly feel that, it's the official narrative around the blowback effect of these sanctions are having on the West that are deliberately watered down is really what we're focusing on. So we note the mainstream news services, they're glossing over the real reason gold is rising in price. I mean, listen to Bloomberg, they talk about every other commodity. Rarely do they mention gold. Or if they do, it's in passing. But completely contra to recent speculation perpetuated by news services such as Bloomberg themselves. And I saw this interview with BlackRock chairman following, this was following gold rising above 1900. Black was spinning the idea that Russia may have to sell gold and flood the market. hey, nice try, boys, but our liquidity providers confirm the Russia has been categorically not been selling any gold. And even before the LBMA cut Russian refiners off the good delivery list, other than for refining purposes, no physical ounces were leaving Russia anyway. In fact, it's more likely that Russia and China are in a position to move to this nuclear option of pricing oil for gold. Now, historically, every single effort to undermine the petrodollar exorbitant hegemony privilege did not end well for the countries trying it. However, Russia, China, they're nuclear powers, so can only be sanctioned, not invaded. But the irony, this is the irony, is that these sanctions play right in to an own goal of undermining the petrodollar. Now, directly exchanging physical gold for physical oil will force the paper gold credit market to allocate those positions into physical, which will destroy the paper gold market and revalue physical and paper gold, because it cannot diverge, significantly higher. Now, all the gold-rich BRICS countries would be very, very happy to import Russian oil benchmarked to a significantly higher gold price. Now, regardless, the current move to back or indeed replace the ruble with a gold-backed currency, it jives with many other reports. Last week, we saw Russia moving towards opening the gold market to its citizens and businesses by removing the VAT element on gold, which really would obviously incentivize the population, cash savings to be moved into physical gold. And it's really swapping rubles versus dollars or euros for physical gold in combination with multi-ton fresh central bank Russian purchases will represent billions of dollars of physical gold suddenly removed from global supply. Now, this sudden unfactored supply shortfall, what it does is misprice billions of dollars of precious metal derivative bets, relying on a much larger volume of backwardated forward supply, which is insufficient to square up unbacked paper bets. And this is unfactored. And it's particularly dangerous for these same actors' bets against silver. Now, I can see you perk up there, Shane, and we will look at silver in a second, I promise. But Russia has gone into these anticipated sanctions with, at best estimate, a $650 billion war chest. Now, backed up by very large gold reserves, which they will increase, not just through buying up all local supply, but by bypassing the petrodollar, swapping oil for gold. That is going to bring them more gold. Now, Russia and Russia can stand many months of sanctions, whilst Western economies move into stagflation and recession. Now, gold is in very strong demand, sufficient to raise the physical price, so somewhere between 2,300 and 2,500, without, and that's Goldman's targets too. I mean, they're just up their targets. I mean, and we all know Goldman's long. And, the oil for gold trade, as it expands, it ultimately raises the gold price by multiples, as what it does is decimate the paper gold trade entirely. Now, when implementing Basel III NSFRs, the BIS fully anticipated gold would have to be revalued, but I don't think at this pace. So, obviously, very short term, we just dealt with short term, we must expect some pullbacks, we're seeing that today. That may offer some fresh entry opportunities for stackers, but medium term, technical damage has been inflicted to the upsides. So really, shorts are spooked.